Good morning, everyone. My name is Neera Tandon, and I'm president of the Center for American Progress. I want to start by thanking our partner, Americans for Financial Reform, for working with us to put together today's excellent event. And I want to thank all of you for joining us for this critically important discussion about our financial system and the risks still posed by shadow banking. Our nation is still recovering from the devastating impacts of the 2008 financial crisis. Poor regulation of the shadow banking credit markets led to risky lending practices that helped destabilize our financial system and plunge our economy into recession. Next week marks the 6th anniversary of the Dodd-Frank Act, and while we have certainly made significant progress implementing some financial reforms, there remain significant risks in shadow banking. Without sufficient oversight, these practices will continue to threaten our nation's financial stability. That's why we're really honored to have this important gathering. This morning's program will begin with brief remarks from Federal Reserve Board Governor and former CAP Senior Fellow Dan Torello. For the last 8 years, Dan has led the board's regulatory response to the financial crisis, and we're truly thrilled to welcome him back to CAP for today's event. Following his remarks will be a discussion with one of the nation's strongest champions on behalf of working families, Senator Sherrod Brown. As a critical advocate for the Dodd-Frank Act and the ranking member of this U.S. Senate Committee on Banking, Housing, and Urban Affairs, Senator Brown has fought tirelessly to bring more oversight and accountability to our financial system. We're, again, really honored to have him. And finally, we'll hear from a terrific panel of journalists and experts who will discuss the nature of shadow banking, the progress we've made since 2008, and the additional steps we need to take to ensure that we avoid the next crisis. Now I'd like to turn things over to the Executive Director of Americans for Financial Reform, Lisa Donner.
All right, thanks very much, Neera, and to all of CAP for hosting, to Mark and Andy for collaborating and putting this together, and to all of you for being here. I want to just add to Neera's comments a couple more words about why we think this conversation is so important. The phrase shadow banking got added to our vocabularies around the financial crisis to describe a set of products and institutions that were central to the crisis, but that went far beyond conventional banking and conventional banks. Things like mortgage-backed securities rather than regular old bank-owned loans, and entities like non-bank mortgage originators, AIG, the giant insurance company, money market funds, investment banks like Bear Stearns and Goldman Sachs. And at the very same time that we grouped and distinguished this set of practices as shadow banking, we also saw a very vivid demonstration of how deeply interconnected they were and are with regular banks, as problems that started in shadow banking soon threatened the center of the regular banking system, and as, in response to the crisis, trillions of dollars in government-supported loans flowed to support securities market activities. As Neera said, Dodd-Frank put in place a number of new tools for grappling with some of the questions and problems created by shadow banking and its complexities, but there's more to do. We have a financial regulatory system that's more fragmented and divided than the financial system itself. Risk flows very easily and quickly between different types of institutions and across the divide of securities and lending markets. Business models change fast. What banks used to do moves to non-banks and vice versa. But regulators may not be flexible enough or have the authority they need to address emerging risks. We may need other tools or other structural changes to create systems that can be effectively regulated and are more likely to serve the real economy. Meanwhile, Wall Street's been extremely aggressive in trying to take back and defang the tools the regulators do have, using both Congress and the courts. Efforts to roll back regulatory powers in this area and in many others have been relentless, and they continue as we speak today, for example, on the Hill. Or will at 10 o'clock. Further unpacking what shadow banking is and what risks it poses is important both to resisting those attacks and to understanding what further steps are needed. So I'm very glad and honored that we will get to hear now from Federal Reserve Governor Dan Torello, who's been a leader in crafting regulatory responses to shadow banking as well as to so many other crucial challenges in the financial system, and then from Senator Brown, a tremendous champion, we chose exactly the same word, in fighting for a financial system that works better for regular people and for our real economy. And then from a panel of experts who will discuss specific challenges in different areas of shadow banking. Governor Torello.
So thank you to Lisa and to Neera for the introductions to the conference. It's a pleasure to be speaking at another conference co-sponsored by the Americans for Financial Reform on shadow banking. I spoke at one about 2.5 years ago, and it's important that attention continue to be focused on the topic, and I'm glad that Lisa and her colleagues are doing so. And it's a particular pleasure to be back at the Center for American Progress, where, as Neera noted, I never was in residence, was down the street at Georgetown, but spent several years as a non-resident senior fellow. The privilege of opening this conference, let me start at the very beginning with the term shadow banking. The very phrase evokes the sense of something hidden, furtive even, a sort of film noir backdrop for extending credit, in contrast to the well-lit setting of the local insured depository institution. In the pre-crisis years, there did indeed develop modes of financial intermediation in which certain features of a counterparty relationship were, if not quite obscured, then at least ambiguous and thus shadowy. Most notable were arrangements in which guarantees of capital preservation or liquidity provision were understood to exist and to have been previously honored, even in the absence of contractual obligations for those guarantees. But as asset values were falling to points unknown, the withdrawal of many of these implicit guarantees by financial entities that were themselves under stress amplified the growing liquidity crunch. Damaging as these arrangements were, however, they do not define the range of issues associated with the term shadow banking. A broader definition would embrace all forms of lending outside of prudentially regulated institutions. And while such a definition might be a useful starting point for purposes of consumer protection, for example, it seems both over and under-inclusive for purposes of regulation to protect financial stability and the resilience of the economy as a whole. There are certainly forms of non-bank lending that do not raise prudential concerns. On the other hand, financial stability concerns can arise where credit extension is only indirectly involved, as might be the case with certain bond funds, or where credit is not involved at all, as might be the case with firms writing large amounts of variable annuities with minimum return guarantees. Rather than dwell on definitions, then, much less attempt to develop a taxonomy of shadow banking, I think it more productive to focus on the characteristics of shadow banking that are most likely to pose risks to financial stability and to the economy more generally. Front and center among these risks is that of runnable liabilities. As has been frequently observed, the recent financial crisis began, like most banking crises, with a run on short-term liabilities by investors who had come to doubt the value of the assets that they were funding through various kinds of financial intermediaries. The difference, of course, was that the run was not principally on depository institutions, as had been the case in the 1930s, but on asset-backed commercial paper programs, broker-dealers, money market funds, and other intermediaries that were heavily dependent on short-term wholesale funding. Lacking enough liquidity to repay all the counterparties who declined to roll over their investments, these intermediaries were forced into fire sales that further depressed asset prices, thereby reducing the value of assets held by many other intermediaries, raising margin calls, and leading to still more asset sales. Those financial market actors who did have excess liquidity tended to hoard it, in light of their uncertainty as to whether their balance sheets might come under greater stress, and their reluctance to catch the proverbial falling knife by purchasing assets whose prices were plummeting with no obvious floor. Runs and panics are the defining characteristic of a financial crisis, transforming debt problems that might themselves have produced a drag on the economy into a classic adverse feedback loop with more devastating consequences. It is important to note that the short-term funding or immediately redeemable investments that can run when a shock hits are likely to have contributed to the vulnerability of relevant asset classes to those shocks. The very short-term nature of the transaction reduces the incentives of counterparties to evaluate carefully the loan or investment they are making. After all, if you can refuse to roll over your repo tomorrow, why be too concerned about whether the underlying collateral may prove to be overvalued a few months later? Consequently, funds may flow into asset classes with less sensitivity to information relevant to the value of the assets driving asset values up and lending standards down, until the moment at which negative information becomes so powerful that everyone wants out at once. Thus, in deciding where, from a prudential viewpoint, to concentrate analysis and policy initiatives within the broad universe of activities that can be described by the term shadow banking, it seems to me that the presence of runnable funding is the key, though perhaps not the only consideration. To be sure, this kind of funding remains at levels well below those prevailing before the crisis, as many of the more damaging mechanisms of that period, such as the infamous structured investment vehicles, or SIVs, have disappeared. Moreover, the largest broker-dealers, both domestic and foreign, that were so dependent on short-term funding in the pre-crisis period have now either converted to or been absorbed into bank holding companies subject to prudential capital and liquidity regulation. New regulatory requirements have placed some constraints on the relationships between shadow banking and prudentially regulated banking organizations. The Securities and Exchange Commission has taken some steps to strengthen its regulation of money market funds and other asset managers whose business models involve substantial amounts of liquidity transformation. But just because the levels of runnable funding are significantly lower than before the crisis does not necessarily mean that they are at safe or optimal levels. And it seems quite reasonable to expect that new forms of financial intermediation based substantially on runnable funding could develop in the future. As liquidity standards, stress testing, and resolution planning evolve, regulators will continue to work on this issue within prudentially regulated firms. But the conditions for destructive runs that threaten financial stability could exist even where no institutions that could be perceived as too big to fail are immediately involved. So I continue to believe that the post-crisis work to create a solid regime to protect financial stability cannot be deemed complete without a well-considered approach to regulating runnable funding outside as well as inside the regulatory perimeter. Again, taking advantage of my spot at the opening of the conference, let me note some key questions to be answered in fashioning such an approach. First, to what degree will it rely on uniform regulation of users of runnable funding, no matter what the characteristics of the market actors and business models involved in the funding relationship? The alternative would be continued reliance on a regulatory response tailored to different forms of financial intermediation and perhaps the relative market significance of the various actors. The advantages of the former, that is a broad definition that doesn't pay attention to the characteristics of the market actors, are that it minimizes at least one kind of regulatory arbitrage and the need for extensive and perhaps constant elaboration. The advantages of the latter are that it might allow more innovation in financial markets, particularly by non-established actors, and could well be more efficient. Second, what agency or agencies would be the appropriate regulators? The answer to this question would obviously be related to the answer to the first, though some different considerations do apply. The choice of a single agency versus multiple agencies involves the well-known trade-off between relative coherence of approach and linkage with other agency functions and expertise on the one hand, versus involvement of multiple agency perspectives and avoidance of too much concentration of authority in a single agency on the other. Third, what form or forms would the regulation take? A non-exhaustive list of possibilities includes outright prohibition, minimum margining requirements and practices, capital requirements, and taxation. Again, the answer to this question may both affect and be affected by the considerations implicated by the first two. My fourth and fifth questions are quite different from the first three, and I'll defer for a moment actually stating them in order to provide some context. To this point, my remarks have reflected the familiar perspective that identifies a set of market practices carrying significant risk of negative externalities, in this case with some collective action problems thrown in, and then asks how to fashion an appropriate regulatory response. An additional important consideration here is that at least some of the short-term funding instruments implicated in this analysis respond not just to the desire of their creators for funding that is cheaper than equity or longer-term debt, but also to the demand of many entities, from other financial firms to pension funds to foreign sovereigns, for safe assets. As the term implies, these assets must be reliable stores of value that are readily available for use, features sometimes characterized as money-like. Obvious forms of safe assets include currency itself, although that has its well-known limitations for large value transacting, government-insured demand deposits, and obligations of highly creditworthy sovereigns such as U.S. Treasuries. But numerous commentators have observed that, for a variety of reasons, demand for safe assets in recent decades has been growing substantially faster than the supply of these most obvious and truly safe forms of government-backed assets. In these circumstances, they note, the demand for privately created safe assets has increased. One problem, of course, is that the privately created assets may be treated as safe in normal times, but as seen in 2008, not in periods of high stress, hence the phenomenon of runs. Another consideration is that the private creation of putatively safe assets is, at least to some degree, the creation of money outside the operations of central banks or of depository institutions subject to reserve requirements and other regulations. With that background, then, here are my last two questions. Fourth, as a factual matter, to what extent is the supply of short-term funding a response to a persistent demand for more safe assets? If the answer is considerable, then further constraints on the creation of currently used safe assets might result in further financial engineering in search of assets that approximate the attributes of truly safe assets even less well, but are the best the demanders of those assets can do. And so, fifth, to what extent does a comprehensive regulatory approach to shadow banking need to include mechanisms involving the government directly or indirectly for the creation of more genuinely safe assets, as well as limitations on the runnable varieties that can precipitate or exacerbate financial stress? This is clearly a big question, one that runs well beyond the scope of even the most far-reaching financial regulatory debates and initiatives of the post-crisis period. It implicates some elements of monetary policy, as well as moral hazard issues and other recurring factors in financial regulation. Consideration of the question of whether government policy should seek to create or create the conditions for private creation of safe assets has already produced numerous interesting analyses and proposals, which in the interest of time I'm not going to talk about here, but which I footnote in the prepared text of the remarks. Some of these ideas move in quite different directions, perhaps an indication that it is not realistic to think we will have an answer in the near term that can command a working agreement among policymakers. But even if that is so, the implications of these questions must be confronted when devising policy responses to the very real risks of runnable liabilities. So I've acted today a bit as if I had reverted to professorial mode because I've given you a bunch of questions. And so I'm going to now bring the opening of the conference to a close, having given you the questions, and look forward to hearing what answers emerge during the rest of the day. Thank you very much.
Hi, I'm Mark Jarsulik. I'm the Vice President for Economic Policy here at CAP. I want to thank Governor Tarullo for his really insightful remarks. I think the issues he raised both about the risks of shadow banking and the complexities of responding to it in a regulatory fashion are incredibly insightful. And now it's my great pleasure to introduce Senator Sherrod Brown, who's the ranking member of the Senate Banking Committee. As Neera indicated in her remarks, Senator Brown is widely recognized as an effective and incredibly important progressive leader. He played a key role in financial market reform during the writing of the Dodd-Frank Act. He's continued to champion those reforms that were enacted, and he's in the forefront of those looking for ways to improve the stability, efficiency, and fairness of our financial system. So it'll be my privilege to join him in a conversation about his views on shadow banking and financial market reform. Senator Brown.
Could I say 1 minute? 1 second before the
Absolutely.
conversation starts. I don't normally come to CAP to sing the praises of Jamie Dimon. You all know who Jamie Dimon is. As the CEO of JP Morgan Chase, he had an op-ed in the paper today, the New York Times, I believe, saying that he was going to give a raise to 18,000 of his employees. In Ohio, he has JP Morgan Chase has maybe 20,000 employees mostly in central Ohio in my state. And he has made a decision. He thinks it's a good business decision, as progressives have argued all along that higher wages for low-income people are good for the community, good for the country, and good for those workers, especially, and morale and the company itself. And I think he's come to that conclusion. I had a conversation with Jamie several weeks ago. I sat across at my high school reunion in Mansfield, my 45th, if you care to know the number. And I was sat across from a woman who in my class of 400, it was a big class, big school, and she had worked at JP Morgan Chase for 30 years, and she was making $30,000 a year. And I passed that on to Jamie, and I think through a whole host of factors, he made that decision. The average teller in this country makes $12.50 an hour, and I think that we're going to see some changes. And one of the things I want to do is, I hope banking chair or ranking next year, is how to bring attention to that. You may remember the last time, some of you might have been here when I was my last trip to CAP and talked about the cafeteria workers that serve food to senators and to staff and to tourists coming in the Senate cafeteria, that they've gotten a major raise because a group of us in the Senate did a boycott aimed at restaurant associates to pay something close to what they were paying union workers in the House doing the same work as non-union workers in the Senate. So a big part of this job is, we can talk about, maybe this is a little far afield, is how do you use this title that 100 of us have in the Senate to do things beyond legislative activity to make people's lives better. And what's better than low-wage workers getting a $2 or $3 or $4 an hour raise, right, Lisa? So, thanks.
Thanks. Let's start with market regulators in the SEC. Last week, you sent a letter to the SEC about their fund rules. What's your assessment of their role in the post-crisis efforts to deal with shadow banking?
I think you start with the fact that SEC wasn't aggressive enough or strong enough a decade ago and leading up to a decade ago, and promulgating rules and enforcement and all of that. They also have not been, I respect the people that work there, certainly the workers that work there and the SEC commissioners, but they've been a little slow in promulgating and enforcing the rules that they need to. I made it a habit. I was sitting with the Fed governor one day several years ago. It was not Dan Terrell, it was one of the regional governors. And he said something to me. I actually wrote it down and I put it under the glass in my desk, and it says, he said, pay attention to what the regulators are doing and signal to them that you're paying attention. And I do it with the FDA. I've worked with Jeff Merkley and Dick Blumenthal and Dick Durbin on pushing the FDA to move faster on tobacco rules. Worked with the Labor Department to push them on the overtime rule to keep the number as high as it could be, and to move more quickly on. I mean, a big part of what a senator should do, again, outside of everyday legislating, particularly in a Congress that's so resistant and obstructionist to anything that kind of is on the side of workers and the side of low-income people and the side of the middle class. How do you do beyond that? And so this letter to the SEC was mostly about pushing them on, in part because they had failed before, in part because they're a little more slow-moving than we should think they should be. And I'm hopeful that to push them ultimately on some explicit financial stability mandate that they need to. It's not just market regulation; it's beyond that, and that's what I'm hoping that we can, particularly with FSOC, get them in that position in the months and years ahead.
So you mentioned a financial stability mandate. Are there other FSOC improvements that you think would help with shadow
Yeah,
banking?
I couldn't hear. I was actually behind the glass with Graham and Katie and Rachel in my office and couldn't hear everything that Governor Turlow said. But he talked about shadow banking, and I want to see FSOC obviously making improvements. I think what they did, I think the GE Capital D designation or undesignation or whatever word we use there was the right thing to do. I think more importantly, it shows that FSOC can be transparent, maybe not quite transparent enough. I'm interested in that. Jennifer's come and talked to our committee. It seems like I see her every week at something, usually in our committee. Jennifer Taub, who I think is going to be in a panel later with Mark and others, or with Marcus and others. But I think what they did with GE Capital shows that this is a process that can work. I want to give FSOC more teeth to regulate large players in systemically important markets. And they've done it with a couple of three insurance companies. Where else do they do it? And what else do they charge them with in terms of getting these, in terms of the individual regulators as part of the FSOC panel to get them to do what they should do, not just regulating activities, but something more than that.
And do you think that under the Dodd-Frank Act, say Section 120, that FSOC already has some authority to do this kind of activity-related regulation?
Yeah, I think they do, and I think that, FSOC, it's kind of interesting that when you were working on Dodd-Frank as a staff person and it was going through the process, sort of everybody said we've got to have some kind of group of regulators so to get rid of just the siloed kind of regulation. And I think, it seems to me that even though Dodd-Frank in the end wasn't bipartisan because Republicans weren't going to let anything that Barack Obama did be bipartisan, no matter how much we listened to them and incorporated their ideas, whether it was FSOC individually or whether it was Dodd-Frank or whether it was the ACA. But I think it's there seemed to be a pretty good general agreement we need to do something like FSOC. I think the structures work pretty well. I think it's important to have Jack Lew as the chair of it, the Department of Secretary of Treasury, and I think it's important that they look at each individual regulator on FSOC and figure out how do they strengthen in terms of financial stability what they're doing, what the FDIC is doing, what OCC is doing, what the Fed's doing, what Treasury does directly, so that they can sort of speak with one voice but charge each of those regulators with the duties they need. I'm not clear on what statutory changes we need to give them that authority. I think they have some of that authority now. I would hope next year, and I'm more optimistic with the Senate Banking Committee next year perhaps than a number of you are. Senator Shelby is term limited out, whether majority or minority, so I will be the chair with Senator Crapo is ranking, or the other way around. We have a working relationship. He's way more conservative than I am. But he's straightforward and honorable, and I'm hopeful we can see some real things happen to make Dodd-Frank better.
Great. Just staying on FSOC for a moment, critics sometimes who want to roll back some of the Dodd-Frank Act and want to limit the role of FSOC claim that there's been a huge power grab by FSOC. That is, that they've started designating firms for regulation, tried to extend the reach of regulation. What would your view be about how things have progressed in terms of the decision making by FSOC on what non-banks ought to be regulated?
Well, of course they have. I think you could have predicted that they would say no matter if FSOC had been sort of somnambulant or if FSOC had been aggressive, anywhere between sleepwalking and aggressive, they were going to say they were too aggressive. That's what the right wing's going to do. That's what Wall Street's going to say. I think FSOC, I'd start with this story. Some of you heard this story maybe. The day that President Obama signed Dodd-Frank back in 2010, 2009, 2010, the chief financial service lobbyist in town said, now it's halftime. And that's how they look at this, that the fight never ends. There's a reason there are hundreds and hundreds, more than 1,000 financial service lobbyists in this town, that these fights will never end. They will always be trying to slow down regulation, slow walk regulation. I mentioned tobacco a minute ago. Every time I've had conversations with the FDA where they're so careful, they're afraid of being sued if they don't do it exactly right, so it takes so long. And our answer is always, the tobacco industry is going to sue you anyway. That's what they do. And every day they can slow down a new rule, every day they can slow down a regulation, there's more money in the bank for the tobacco industry, for every one of those companies. The same with Dodd-Frank, that if they can slow these regulations, they're always going to. And implementation is always an uphill battle that way. That's why, a big part of my job is ranking on banking, but just as somebody that cares about these issues and, joining other progressives is to figure out where we need to go on these issues to get the regulators as much cover as we can by getting a letter signed by all the Democrats on Senate banking or 15 progressive Democrats in the Senate, because they're hearing on the other side, Republicans and the Financial Services Committee in the House, the Republican majority passes bills all the time, sends letters all the time trying to weaken these rules. And I don't want that to operate in a vacuum. That's why we're always going to be there on making sure that we are defending rules and sometimes trying to make them stronger, obviously. Because there's some things. I wanted to do some things on capital that were much stronger than Dodd-Frank. I think that the committee and the staff did a really good job by and large. There's certain things we couldn't get done, and those fights aren't over either on our side. So it's not just playing defense to protect the best of Dodd-Frank. It's pushing the envelope to get them to be more aggressive and for us legislatively to weigh in when we can.
But we do still have to play a certain amount of defense. Are there particular threats to FSOC and its functioning that you're concerned about?
Yeah, one of the threats is it's always a threat of funding, what they do with funding. I'm always concerned. I think that they don't like the structure. They don't necessarily like Jack's leadership in it. They are going to, when FSOC does a SIFI designation, as they did with MetLife, a number of us wrote a letter defending opposing the court case. But one of the threats is I don't have great fear, but I have concern that court decision in terms of the court implying that cost-benefit analysis is the way to go. Republicans love cost-benefit analysis because you can only, they then can talk about all their costs, but it's pretty hard to quantify the benefits of avoiding a recession or avoiding a financial implosion or meltdown. How do you, so when you look at all these issues, if you do cost-benefit, in the end, the side of protecting the public isn't quantified very accurately or fully or comprehensively or very well. So this whole, cost-benefit analysis, boy, that sounds like a good idea. It does sound like a good idea, but it just never works. And they've played that game. When I was in the House for many years, I was on the Energy and Commerce Committee on environmental rules, on clean air stuff, on safe drinking water, and I represent Lake Erie. I live very close to Lake Erie, and I know, what the importance of that lake. It's the shallowest Great Lake. It's the shallowest 30 feet deep. It's vulnerable to all kinds of things. It's hard to quantify the benefits on protecting Lake Erie. It's easy to show the costs to industry of protecting Lake Erie. So I think on all of these issues, it's always a challenge, and we've got to beat back any legislative efforts there. That's part of the reason a number of us weighed in on that SIFI designation court case with MetLife.
Where the courts seem to read into the statute a cost-benefit requirement that really isn't in the statute.
Yeah, and I know this judge was a Bush appointee. I don't know much about her. She seems pretty conservative, and I know the sort of the Republican mantra of the last 2 decades is cost-benefit analysis when it comes to safety and health rules to workers and to protecting the environment and for financial services. And just the whole fear. I'm always concerned, if not fearful. I don't think of myself as a particularly fearful person, but about regulatory capture. I think, and certainly in the Bush years, there was far too much influence that Wall Street and the non-bank sector too, the shadow bank system had on the regulators. You were fighting that as a staff person always. That's one of the reasons that, that federal governor said to me, watch us and let us know you're watching them, because it's always, this town sings with an upper class accent, and it's important that people that are on the right side of these issues, as the next panel always knows to push back, and that's why I look to people in this town like you and like them, to a number who have testified to our committee, people like Marcus and all and Dennis and others, to show us what they're seeing with potential regulatory capture and always push back.
Let's move a little bit to some of the other aspects of the shadow banking system about which you have some concerns. Derivatives were kind of an early entry into the building out of the shadow banking system. They're a way of creating financial products which are pretty similar to ones that are existing, but which were regulated. And Dodd-Frank in Title VII tried to modernize the regulation of derivatives, create a new framework for it. What's your assessment of how that's worked out?
Well, it's getting there, but I think the pressure, when outside groups, often members of Congress, conservative Tea Party members of Congress, or just members of Congress that are close to Wall Street, when they do the bidding of these outside groups, when the CFTC and the SEC are subject to appropriations, it makes it a whole lot harder to keep them from caving, maybe is too strong a word, from lying, from not being as aggressive as they should on rules and regulations. So, I would like to figure out how we deal with the whole appropriate. That we appropriate, that they've got those two agencies which are so important, particularly CFTC with derivatives, that they be. I think we should really re-examine how they're funded. Ideally, I think they shouldn't be appropriated. I know that will be controversial. That will be difficult. I'm also concerned, and speaking of regulatory capture, the whole Energy Advisory Committee coming out of CFTC, that Energy Advisory Committee, which, if I recall, had 8 out of 9 people on it that were giving advice to the CFTC. 8 out of 9 were out of the energy industry. That doesn't strike me as a very good ratio to protect the public.
Yeah, and that was a committee that was advising the CFTC about the issue of, say, position limits in the energy market.
Right. So but again, we exposed that, and it it didn't look good in the light of day, and so that's kind of the role that the sort of informal role we play here. I think we should think about creating a systemic risk advisory committee. I think the CFTC needs to kind of examine those issues a bit better.
Okay, I know that you're pressed for time. You have to get going. One final question, perhaps. We learned about the connection between the non-bank sector and the banking sector during the crisis. Do you think there are other things that need to be done in terms of bank reform to address that interconnection and the risks that it poses?
Yeah, we should look at rules and commodity trading. We brought this to light in a subcommittee hearing when the Democrats were in the majority. The Fed's been too slow moving on it. I think regulators can do more on living wills. I remember back, the C-SPAN asked me to interview Ben Bernanke after he had left office, after he'd written his memoir. And you may remember that he had, and this was in the news at the time, but he was working on a book when he was tapped by the Bush administration to be one of the Fed governors. And if I can recall the name of I want to make sure I get this right, the name of the book that he was working on, it said something like bankers and politicians' role in causing the Great Depression. It was a little stronger than that. And so during this interview, I asked him, during a C-SPAN interview, which I did maybe 6 months ago, I said, what would you call, if you were writing a memoir, if you were writing his history of this financial crisis, what would you call it? What would you call the book? And he said, he gave 2 answers. He said, I want to make sure I get it right, asleep at the switch or too complacent. And I think that when I look at the Senate Banking Committee, you can sit there, and a number of you have, as I said, testified or watched this. You can look at the other side and you just see this collective amnesia that we didn't really have that much of a problem, and it just is remarkable because it's been less than a decade since all of this blew up. So I just think that we need to, as I said, look at living wills, at what regulators can do more. I mean, we've seen the living will process, I think, generally works. That was Title II, right? Was it Title II? Yeah. And I just think we need to be paying more attention to that. Can I ask you a question before we leave? Okay, what you were part of obviously writing all this. What more should we be doing?
You know, I think there's a lot of potential still in this legislation that hasn't been realized. One place where the entire regulatory system is at a real disadvantage is information. That is, we don't understand even now where the risks of repo, one of the kinds of short-term funding that Governor Tarullo was talking about, we don't know where they're lodged and how big they are because the data simply aren't available. We gave the Office of Financial Research the mandate and the authority to gather those data. They have subpoena power if they need to use it. And here we are, how many years out from the financial crisis, we still don't understand the basics of a lot of these short-term liabilities that are funding and creating risk in the shadow banking system. So I'd really like to see the OFR step up and produce the kind of data that regulators and legislators need when they're looking at risk.
Well, thank you. The range of the range of estimates of the size of the shadow banking system it's like 15 to 60 trillion or something. I mean, the numbers are just
it's
gargantuan, and it just shows how little we know and how we don't quite know how to define it and measure it the way that we should, right?
Absolutely. Yeah. Well,
thank you.
Senator, I know you have to run, but thank you very much. This has been great talking to you.
Thanks. Thank you all. Thanks.
Okay, well, give it to Adam, actually. He's going to be, I don't have... All right. I'd now like to introduce a panel of... Oh. Okay. All right. I'd now like to introduce a panel that is going to be taking a deeper dive into specific elements of shadow banking. I think one impression that I'm sure we've all gotten so far is that shadow banking is an issue of enormous scope and complexity. So we certainly don't expect this panel to examine every element of it. But I thought that it would be we thought that it would be valuable to have a group of experts sort of take us on a tour of various dimensions of shadow banking, starting with an overview and then looking at certain kinds of institutions that are critical both to shadow banking risks and to control of those risks. So I'd like to both introduce the panel and talk a little about what each person will be discussing. Speaking first, we're going to have Adam Ashcraft, who's a senior vice president at the Federal Reserve Bank of New York. He works in the financial risk management area of the Credits and Risk Payment Group. And any of you who are familiar with the academic literature or the debate on shadow banking will know that Adam has been the author or co-author of a number of the very important and seminal papers, the first papers to look at and sort of lay out the territory of shadow banking. So he's going to be starting off with an introduction to what shadow banking is and a little discussion of how shadow banking has continued after the financial crisis. We're then going to have Carolyn Sissoko. who's a fellow at the University of Southern California Center for Law and Social Science. She is both a lawyer and an economist, which I actually think is a very valuable combination of skills for understanding shadow banking. And she is going to talk about the connection between the conventional or commercial banking sector and the shadow banking sector, and how we can understand and regulate these connections. Then we're going to have Jennifer Taub, who got a very nice mention from Senator Brown as being ubiquitous on the as a witness on the Senate Banking Committee. Dr. Taub is a professor at the Vermont Law School, and she is an author of a recent book on the financial crisis called Other People's Houses that I very highly recommend. And Professor Taub is going to discuss the world of funds, mutual funds, money market funds, private funds such as hedge funds, and how these funds play an important role in shadow banking, and how their role has actually in some ways increased since the crisis, and how we can regulate them. Then we're going to have Daniel Schwartz, who's a professor of law at the University of Minnesota. And Professor Schwartz is an expert on insurance law and regulation. And as we saw with AIG during the financial crisis, as well as the monoline insurers who were the insuring many of the toxic assets, the mortgage bonds that helped drove the crisis, insurance is actually a central area in shadow banking. The role of insurance companies and the proper regulation of insurance companies is both a very, very live and intensely combated political question right now, and a very important issue for the control of shadow banking. And finally, we're going to have Bill Harrington, who's a senior analyst of asset-backed securities at Debtwire. And for 15 years, he was an executive at Moody's Investor Service, rising to be an executive vice president at Moody's. And I think one of the central elements of shadow banking is its role in the production of securitizations that play an enormously important role in intermediating credit and in the credit markets, and often involve the participation of both banks and multiple non-bank institutions. And of course, these securitizations were a central driver of the financial crisis and a key product of the shadow banking system. And one of the most important sort of regulators of the securitization system is credit rating agencies. They are the entities that give the seal of approval that allows securitizations to be sold and to be treated as supposedly safe assets. And we saw a massive failure of the credit rating agencies in the financial crisis, where they certified actually the great majority of the toxic assets, the toxic mortgage assets that drove the crisis, as investment grade assets that were safe for institutions to hold, and institutions and investors to hold. And that was really a central contributor to the financial crisis. And Dodd-Frank did address the regulation of credit rating agencies, but many of us believe that the steps taken in Dodd-Frank have not been properly implemented and did not go far enough. So Bill is going to discuss his experience at credit rating agencies and the proper regulation of credit rating agencies. So without further ado, Adam.
Great. So thank you very much for the opportunity to talk to you about shadow banking. We're going to get some slides up there, but while we're waiting for that, I can talk to you a little bit about, I guess, what I hope to accomplish. First, I wanted to return to definitions. Whenever you talk about shadow banking, the topic is just so broad, it's really important to narrow the scope of what we're talking about, give you some motivation for that definition, why it's important and recent experience, and then to try to put out a framework for regulation that hopefully we can use for the rest of the panel to talk about where the areas that we need to focus. Before I get started, unlike the governor, I do have a disclaimer. Anything I say is my own view and not that of the Federal Reserve or the Federal Reserve System. If you want to know what the Fed thinks, I refer you to his speech this morning. So going to the first slide. All right, so just first talking about definitions. Shadow banking versus traditional banking. Traditional banking really is focused around the combination of loans and deposits, taking illiquid assets and funding them through money-like instruments. And we emphasize in our research that this is through money-like instruments that have the explicit backing of the official sector from a credit and liquidity perspective. That's important because those type of bank liabilities are what we've traditionally thought of as being money. Money is an important part of the financial system. It's crucial to the ability of the financial system to operate, and it only has value because people believe it has value. There's a very important empirical connection between public confidence in the banking system and the value of money and economic activity, and the fragility that we've observed over the years in confidence around money has kind of prompted the regulation that we have, obviously, of the banking system. Shadow banking, in contrast, is going to be the funding of illiquid assets with money-like instruments that do not benefit from the explicit backing of the official sector. That's important. It's an important definition to narrow our discussion in some important ways. First of all, it's an activity-based definition, not an entity-based definition. So there are a lot of activities of commercial banks that fit in this definition, like funding loans with short-term wholesale funding. And so we think it's important to acknowledge that there are shadowy activities of commercial banks that need to be measured and regulated. Also, I want to emphasize that it's focused on maturity transformation in the shadow sector. There is something we refer to as shadow credit intermediation. That's securitization. We do think that there are lots of challenges with securitization. Done a lot of research on this area, on the incentive problems that exist, and on the need for additional work in order to improve securitization. But I'm focused here really on shadow banking, which is really taking illiquid assets and funding them by money-like instruments. The reason for that is that's where I think the real prospect for systemic crises is. That doesn't mean that securitization can't amplify the cycle or create problems, but to the extent that you want to avoid systemic banking crisis, you really need to regulate private money. So the next slide is to give you some motivation for why this is important. The first, obviously looks at the experience of Northern Rock in September of 2007. This is just your classic bank run, but there are a couple of important observations to make about this related to why we think regulation of shadow banking is important. The first of which is bank runs are just really scary, and they can correspond to very widespread changes in sentiment that don't just affect the institution under distress, but affect markets more broadly. And so there's contagion not only to other institutions, but to other markets that adversely affects economic and financial activity. The second point is that, while when we think of bank runs, this is the picture that most of us see, what we don't see is what happens the days before this bank run, and that is large depositors taking their money out of the bank. People that are more sophisticated and have the ability of basically getting out before the public or the government is basically left holding the bag. So there are important distributional issues associated with a financial system that's structured in this fragile way. On the right-hand side is basically a graph from Reinhardt and Rogoff, which basically emphasizes that following banking crises, we have very severe declines in activity and increases in unemployment. So on the median post-war banking crisis, you're looking at unemployment going up by 7% and unemployment being elevated for a period of 5 years. This is a fairly costly episode for an economy to go through. And so when we talk about measuring the benefits of regulating shadow banking, it's to basically contain these types of issues. I'm going to give you a little time, not talk about Texas bank failures and focus instead on giving you a historical perspective on shadow banking more broadly. This chart basically uses the flow of funds to kind of measure the size of the shadow credit intermediation system and shadow banking over a much longer time period. So what we've done basically, looking at yellow is looking at traditional maturity transformation inside banks. The green is basically looking at credit transformation inside banks of insurance companies. The red basically is shadow maturity transformation. So this is basically private money. And the orange is basically credit transformation outside of banks. And so a couple of observations to make about shadow credit intermediation and banking more broadly. You'll see that first, financial innovation relative to GDP has increased rapidly. And a lot of that is related to not just maturity transformation in the shadow banking system, but credit intermediation. So we've had a significant deepening of credit markets, which generally we think is a good thing in providing individuals and companies access to credit. The challenging part of this is that if you see the sum of the red and the yellow, overall you'll see the increasing importance of private money in the overall money supply. And you saw that going up until the crisis, that we were becoming increasingly reliant on private forms of money in order to finance a significant share of credit. This left the system vulnerable to a loss of confidence in that, in the value of that money, and ultimately led to the crisis that we talked about. Just to give you some specific examples, I throw you 3 charts of runs in shadow banking. At the top left, you basically have the asset-backed commercial paper market in green. What you basically see up here is the run-up in asset-backed commercial paper issuance, related to regulatory arbitrage vehicles and the interest in basically funding subprime assets using money-like instruments because they were the most risk-insensitive sources of funding. You see a significant growth in that relative to financial or non-financial asset-backed commercial paper. And then when the public sector finally loses confidence in August of 2007, you see the rapid decline and run on that form of money. Over here on the right-hand side, you see the repo market. You see a rapid increase in the amount of overnight repo relative to M2, which is just a broad measure of money supply. And then following the failure of Bear Stearns, you see a rapid decline in the amount of basically overnight repo up and until through the end of 2009, and it obviously hasn't recovered since then. So again, another money-like instrument that was subject to excessively pro-cyclical holdings by the public. And one of the more scary episodes is obviously when you look at money market mutual funds. Here you have prime funds, which hold assets which are obviously broader than just government securities. Government funds, following the failure of Lehman, you had this rapid movement of assets out of prime funds and into government funds, which led to significant disruptions in the short-term money markets. So again, these are just examples of the types of runs that happened in 2008 that generate a cause for concern, and obviously were contributing factors to economic performance following. Understanding that I have a time limit, I'm going to try to just give you a framework for thinking about regulation and then defer to the rest of the panel. So what we have here on the left-hand side of this chart basically is an illustration of traditional banking and how we think about prudential regulation of traditional banking. And we focus on the types of assets that go into the institutions. Ultimately, you want to prevent the patient from dying. If you can prevent the virus from getting in the patient by regulating the asset quality, that's obviously the best way to go. To the extent this is imperfect, you want to regulate the amount of leverage that they're able to get against those assets, obviously through capital standards. And the other important prudential regulation is focused on liquidity. And so in thinking about how to protect the financial system from the risks of private money, the first thing that we can do is to make the banking system as resilient as possible to unforeseen shocks through the regulation of asset quality, funding, liquidity, and leverage. The second way in which regulation is focused by trying to influence what happens in the shadow banking system by focusing on interactions that exist between traditional banks and shadow banks. So a lot of the problems that we had with asset-backed commercial paper conduits were related to regulatory arbitrage transactions that were happening in the traditional banking sector. Those things have been cleaned up and that activity has ceased. As a third example, the FSOC obviously has the ability to change the boundary between shadow banks and traditional banks. There are costs and benefits associated with doing that. For one hand, you can get prudential regulation to cover more firms in the financial system. However, changing that boundary also has the potential for providing those firms access to the safety net, which can aggravate moral hazard concerns and create perceptions of too big to fail that also that need to be managed. So lastly is more directly getting at what's going on in the shadow banking system, and this is focused on prudential market regulation. So these are things like regulation of NRS ROEs, regulation of money market reform, or, for example, risk retention of securitization transactions. And so we can talk about those probably in the discussion. But this, I think, is a good framework for thinking about what are the different ways we have of approaching regulation of the shadow banking system. And in a discussion, we can kind of talk about where are some of the opportunities using these lenses in order to further improve. So I'll stop there. Thank you.
first, let me say thank you for asking me to come here to talk about shadow banking. I'm here to present a banking scholar's view of shadow banking. And my first point is that the runnable aspects of the shadow banking system exist to a large degree because of the regulator's approach to banking. Adam pointed out that the key characteristic of shadow banking is that the short-term funding of illiquid assets is done without explicit guarantees from the official sector. But as Governor Tarullo and Adam also pointed out, when you look at the funding sources of shadow banks, you find that the runnables are often supported by explicit or implicit guarantees from the commercial banks, right? So the shadow bank funding that caused so many problems in 2008 generally took two forms: commercial paper and repurchase agreements. Both instruments were protected by bank guarantees. You might say, well, what about prime money market funds? Well, they're protected by these guarantees because the main private sector assets they're investing in are commercial paper and repurchase agreements. My second point is that regulators can police the boundaries between banks and shadow banks, or they can choose not to do so. Prior to 2008 crisis, they chose not to do so. Commercial paper, for example, was protected by explicit liquidity facilities extended by the commercial banks. Since the crisis, the regulators have successfully controlled the commercial bank activity with respect to commercial paper. And I'm not really going to talk about commercial paper. Repurchase agreements are a different matter. Two forms of commercial bank support protect this market. First is the intermediary role of the commercial banks in the tri-party repo market. And second is that JP Morgan Chase Bank, and I'm talking about the FDIC-insured subsidiary of JP Morgan Chase, has been a market maker in repo for the past 2 decades. In the same sense that Drexel supported the junk bond market, we have JP Morgan Chase supporting the repo market. A little known fact is that the Glass-Steagall Act of 1933 explicitly prohibits commercial banks from playing this role with respect to corporate securities. Not only does it explicitly prohibit the role, it's never been repealed. So you're saying, well, wait a minute, if that's true, how can we have a tri-party repo market? It's because of a legal fiction. For the purposes of bank regulation, repos are not loans on the security of stocks, bonds, or other investment securities. So we have this kind of legal fiction that's allowing something to exist that in the 1930s we knew was going to be a problem. If the lessons of the 1930s had actually been learned, the role of JP Morgan Chase Bank, both as a tri-party clearing bank and as an FDIC-insured market maker in repo, would never have been allowed to develop. Now, the Federal Reserve has been actively reducing the extent of the commercial bank guarantees supporting the tri-party repo market. The issue is that it hasn't come close to addressing the question of why there should be any commercial bank support of the repo market at all. So when it comes to the repo market, the regulators aren't really policing this boundary between the commercial and shadow banking. And through the repo market, the implicit and explicit commercial bank guarantees are still playing a significant role in the repo market aspect of the shadow banking system. I also want to make the point that the repo market's closely connected to the derivatives collateral, which is another source of shadow bank funding. And when you look closely at all the entities that we're so worried about creating financial instability through shadow banking, and we're talking about hedge funds, mutual funds, insurance companies, the common ground is that these three instruments, commercial paper, repurchase agreements, and derivatives collateral, are usually implicated. So what should the regulators be doing about shadow banking? I think they should be policing the boundary between commercial and shadow banks in order to make sure that the commercial banks aren't providing implicit or explicit guarantees to shadow banks. Of course, as you heard from both Adam and Governor Tarullo, this isn't news to regulators. They totally focused on this issue with commercial paper, and they got control of it. It's less true with the repo market, and I think that's kind of the next big issue that needs to be addressed. An important aspect of this policing role is that the regulators need to be willing to restrict bank activities at the product level. Now, a good example of how you do this right is the regulation of leverage loans. When the regulators evaluated the leverage loan market in 2012, they found the same flaws that characterize the subprime mortgage market, Essentially, competition was creating a race to the bottom as banks won market share by making loan terms easier for borrowers. They issued a guidance designed to improve the quality of these loans, and when the banks tried to circumvent the regulation by financing non-bank lending on leveraged loans, the regulators explicitly restrained this activity too. The evidence indicates the regulators have been successful in their efforts to improve the quality of leveraged loans, although people sometimes focus on the quantity, and they're like, well, the quantity didn't go down so much. Well, the regulators really wanted to improve the quality, so discussions about the quantity kind of don't even target what they were trying to do. It's important to recognize that this success in the area of leveraged loans and to empower and encourage regulators to engage in this kind of product-level regulation across the board. The dangers of financial markets of destabilizing competition have been recognized for centuries, and if financial stability is our goal, we need regulators who are going to be very proactive in monitoring the development and marketing of bank products and enacting whenever the signs indicate that competition in financial markets is having adverse effects rather than beneficial effects, just as they did in the leveraged loan market. So this is my bottom line. Step one to controlling runables in the shadow banking system, or to controlling the non-bank lending that poses a risk to financial stability, is for regulators to carefully police the boundary between commercial banks and the shadow banking system. On this basis, repos and derivatives collateral markets still pose a big problem. Furthermore, in order to make regulation effective for the future, leveraged loan-like product-level supervision of the banks is going to be necessary to make sure that financial innovation isn't facilitating the growth of shadow banking through new forms of commercial bank support. Thanks.
Before adding to this discussion, I wanted to thank Marcus Stanley of Americans for Financial Reform and Andy Green and his team here at the Center for American Progress for organizing and hosting this event. Today, I would like to address the reality and the rhetoric of shadow banking. By shadow banking, just to get back to definitions, I mean those entities other than traditional banks that gather together customer savings and channel those savings into loans and other financing to businesses and consumers. Among these shadow banks are pooled investment vehicles. These entities hold about $26 trillion in assets. They include, for example, money market mutual funds, other mutual funds, hedge funds, and private equity funds. With pooled investment vehicles, instead of making a deposit, a saver gives their money to a professional asset manager. The asset manager then invests the money into the capital markets, and some of that money ends up going to borrowers at the other end. Instead of withdrawing your savings as you would with a traditional bank, with a pooled investment vehicle, you redeem your shares in cash out of the fund. Problems can arise when investors seek to redeem, but the money is committed to assets that are illiquid and can't be sold readily at full price, or assets that have declined in value and eroded the equity in the fund. Fear can cause runs and asset fire sales. This is quite similar to traditional banking. But the word shadow is used, as we've already heard, because these entities have not been subject to oversight and supervision by the banking regulators. And correspondingly, they are not supposed to have access to support from government safety nets, such as FDIC insurance and lender of last resort protection from the Fed. The belief has been that shadow banks can self-regulate. Their customers and other counterparties can monitor and discipline them. Okay, so let's move to the reality of shadow banking. The reality is this hands-off approach did not work. Shadow banking contributed to the 2008 financial crisis. The runs on and failures of Bear Stearns and Lehman Brothers are notorious examples, but we should not forget the problems with pooled investment vehicles. This includes the $300 billion one-week run on the money market mutual funds. As you might remember, this massive run occurred when investors of a single fund, which was heavily invested in Lehman Brothers short-term debt, panicked because Lehman Brothers had filed for bankruptcy. And when they panicked, and they pulled their money, the fund also broke the buck, which means the fund was no longer able to return to redeeming investors the $1 per share they expected. But again, remember, this was a shadow bank, so it's not supposed to be protected by deposit insurance or government support. But stopping this run did require unprecedented government intervention. Another reality is that pooled investment vehicles could still pose a threat to the financial stability of the United States. That said, as a result of Dodd-Frank, the regulators do have more tools to see more clearly what is happening in the shadow banking sector, and they have the authority to regulate entities and activities. And we've already heard this, but some additional facts on the good news is that they've already begun to do so. Examples include the SEC's efforts to address risks with money market mutual funds, and the SEC has also introduced recent proposals concerning liquidity and the use of derivatives by mutual funds. In addition, after Dodd-Frank, managers that advise hedge funds and private equity funds, for example, must register with the SEC, and they're subject to examination by the SEC. Even more importantly is these private funds must now provide reports to the SEC and FSOC revealing the risks they pose to financial stability. These reports are important because they provide information for the first time on the size of these funds, the amount of borrowing, and derivatives in these funds. This reporting also shows interconnections between shadow banks and traditional banks. However, according to a unanimous FSOC report from April of this year about asset management, better data are needed. The FSOC is now establishing an interagency task force to come up with what more information that might be included in this Form PF. So the regulators do have a window in. They can finally begin to see the elephant in the living room. And don't you know that just as this happens, shadow banking lobbyists are running down here to Washington to get Congress to slam the windows shut, turn off the lights, and pull the shades. If they have their way, mid-sized hedge funds with assets of up to $1.5 billion will no longer be required to disclose critical information. This includes this very extensive Part 1C of Form PF. They won't disclose this critical information to the regulators, and all private equity funds will be able to hold back important information. You have to ask yourself why these folks don't remember the adage that you cannot manage what you cannot measure. How can we expect our regulators to do their job if they cannot see what's going on? Okay, so what's the reasoning of the shadow bank lobbyists for saying we should not have to disclose this information and that the government should lay off on regulation? The reasoning is it's not us, it's them. It's the traditional banks. So this brings me to the second part of my remarks, which is the rhetoric of shadow banking. As you know, there are many who still try to delay, dilute, and roll back post-crisis reform of traditional banks. And one way that these safe banking opponents resist reform is they claim it's not necessary because it was the shadow banks that caused the 2008 crisis, failed, and required bailouts. Talk about amnesia. The entire toxic mortgage supply chain, from home mortgage origination through securitization, also involved traditional banks. As just a few examples, IndyMac failed in early 2008, requiring more than $9 billion from the FDIC Deposit Insurance Fund. Washington Mutual's parent company filed for bankruptcy, and the government committed about $476 billion in cash and guarantees to rescue just Citibank alone. Safe banking opponents also contend that if we require traditional banks to take common sense steps, like reducing their dependency on debt by raising equity capital requirements, that all of the risk will move to the shadow banking sector. This is downright deceptive. So you get this, right? The shadow banks are saying, it's not us, it's them, and pointing to the traditional banks. And the traditional banks are saying, it's not us, it's them, pointing at the shadow banks. So we need to cut through this rhetoric and instead support common sense regulation of activities and entities that present systemic risk regardless of their labels. In conclusion, we need first better data on leverage from private funds. We need to improve liquidity and reduce the use of derivatives at registered funds. And we need to increase capital at traditional banks and also to enforce the consequences of non-credible living wills. Thanks so much.
Great, thanks. So I have some slides that I'll wait to get up there, but before I do, I'll thank the Center for American Progress and Americans for Financial Reform for hosting this great conference and for inviting me to be a part of it. So I'm here to talk about shadow banking and insurance, a topic that has become increasingly important, most notably by the fact that FSOC has designated 4 entities, 3 of which are, in fact, predominantly engaged in the business of insurance. And so I want to talk about shadow banking and insurance, if I can get, there we go. But before I do, like everyone else, I want to define my terms. And I'm going to be using basically the same definition that everyone else has been using, potentially short-term liabilities backing potentially long-term or illiquid assets where we don't have the traditional restrictions of bank regulation and the traditional guarantees. But before I discuss and march through each of these prongs in relation to insurance, I want to make an important note, which is that shadow banking is one way to conceptualize systemic risk, but it is not at all the only way. And indeed, one of the reasons why insurance companies may pose systemic risks is not because they necessarily meet this definition in every way, but also because they are systemically risky in other ways. Governor Tarullo mentioned variable annuities. And indeed, one of the major ways in which I believe insurance companies, and FSOC has noted in its designations, pose systemic risks is by essentially guaranteeing that equity markets won't decline to a tremendous amount of the American population. And then using very complicated risk management measures that are not necessarily fully transparent to try to hedge those risks. Hedges that didn't effectively work in 2008, or at least perfectly work, and are very hard to accomplish. So I want to be clear that in discussing shadow banking, we are not exhausting the universe of potentially systemically risky activities. That being said, I do think it's clear that there are various elements of insurance companies and insurance entities that qualify for this definition. And to show you that, I'm just going to walk through the terms. So let's start with potentially short-term liabilities. Insurance companies love to say, hey, our liabilities are long-term. We're going to pay out in 20 or 30 years. And of course, that's usually the plan. But many insurance products actually allow policyholders and owners to withdraw if they become nervous. And this is true across a wide portfolio of different insurance products as the insurance industry has evolved. So it includes not just GICs and synthetic GICs, where the counterparties are very sophisticated entities that may have withdrawal rights and are likely to withdraw if they become substantially nervous about the entities, but it includes deferred annuities, where the only thing stopping withdrawal are in fact surrender charges, and those surrender charges decrease over time. And those surrender charges can be changed based on the product design. There's nothing inherent to a deferred annuity that says you have to have large surrender charges at all. It can include funding agreements. It can include retained asset accounts, which don't get talked about a lot, but are essentially bank accounts. So there is nothing fundamental about an insurance product that makes it a long-term liability. And indeed, increasingly, insurance products are changing so that there is more optionality. Moreover, it's not just the insurance products themselves. One of the important elements in the designation of insurance companies as systemically risky is their use of what's known as captive reinsurance, which some have labeled shadow insurance. Now, the extent to which that analogy applies can be debated. But one key element of captive reinsurance that qualifies under the narrow definition of shadow banking that I employ in this talk is the fact they fundamentally rely on short-term letters of credit from banks. And banks can decide in many cases, not to reauthorize that letter of credit if they become nervous about the underlying entity. They can, in fact, run on the captive reinsurance regime, which then can actually result in all of the liabilities that are hidden through shadow insurance magically reappearing on insurers' balance sheets. Moreover, there's just a new paper out today on securities lending operations of insurance companies and how many insurance companies use short-term securities lending arrangements to invest in long-term assets. There again, important activity that's relatively pervasive in the insurance industry that was fundamental, by the way, to AIG's demise. That essentially is a short-term liability. So there's no doubt that there's the potential for short-term liability insurance, and I should say this to be fair. There's also little doubt that insurers' liabilities are less short-term than traditional banks. But where we are on that spectrum, and more importantly, where we will be as the industry evolves and products change, is very hard to know. What about the asset side? Well, insurers, believing and anticipating that their liabilities are long-term, naturally invest in long-term assets, assets that are not necessarily very liquid, like corporate bonds or securities-backed asset, mortgage-backed assets, on the assumption that that will match their liabilities. That, of course, creates problems if there are immediate liquidity needs because of a run on the liabilities, just in the same way as a traditional bank failure. But the story is even worse than that because there's substantial evidence that insurers tend to herd in their investment strategies. They invest in the same types of corporate bonds. They invest in the same types of mortgage-backed securities, whether for regulatory reasons or credit rating agency reasons or what have you. What that means is that their assets are particularly likely to become illiquid when there's a shock to the industry that tends to cause their liabilities to become short-term. So we satisfy condition 2. Finally, condition 3, as with everyone, I'm wary of my time, and I also have there we go, condition 3. What about the regulation? After all, insurers are regulated. But there is not FDIC insurance for insurance products. Instead, there are state guarantee funds, which have very substantial limitations in terms of what they explicitly cover, which are not even pre-funded, and which fundamentally rely on funding after the fact, which means they rely on the notion that the industry is doing well and costs can be recouped. But if you have a systemic event, it might be harder to recoup those. At the same time, yes, we have prudential regulations. State insurance regulators are regulating insurance entities, but they're not doing so at all, or at least not very much, on a consolidated basis. They're not looking at the entity as a whole, by and large. Virtually all of their regulation is focused on the individual insurance entities within a company. And if you want to go back and look at what happened with AIG, the reason it failed, or one of the key reasons, is because you had different regulators who understood small little parts of AIG, but no one saw the big picture. No one saw how the company had simultaneously bet on mortgage-backed securities in both its credit derivative swaps portfolio and its securities lending portfolio. You need to see the big picture at an entity-wide basis in order to regulate for systemic risk purposes. And state insurance regulation fundamentally doesn't do that because it has to carve up the entity and give different responsibilities to different states. So for all of those reasons, I would say that we do have shadow banking in the insurance industry. Obviously, my time is limited. Here are some citations to my other work that expands on these concepts more broadly, but I look forward to talking during Q&A about some of these themes. Thank you.
Hi, good morning. My name is Bill Harrington, and for 7 months, I have been a journalist at DebtWire ABS, and we report on the securitization markets as well as derivative contracts. But this is a career shift. From 1999 until 2010, I was a derivatives analyst in the group that rated the complex financial products at Moody's Investors Service. From 2010 to 2015, prior to joining DebtWire, I engaged in what I am thankful for the movie The Big Short gives me some language that hopes can explain what I did. My work was the coda to the coda of the movie version of The Big Short. At the end of The Big Short, there's a list of what happened to some of the principals in the movie. And one of them became very interested in explaining to regulators what the problems were in the markets that enabled him to profit while he was trading. And he was rebuffed, and at least the movie said he was checked by the Internal Revenue Service 4 times for his troubles. Because I had worked in the derivatives group at Moody's, and because I was exceptionally proud of my work, because I found it interesting, because I assessed derivative contracts and CDOs, and derivative contracts and derivative providers, and derivative contracts and insurance companies, and derivative contracts and municipalities, and derivative contracts and corporations. And my interest was simply to do a good job and keep making sure that within the closed rating system, credits and debits balanced. If two parties entered into a contract and it seemed to give losses to one party, it should be reflected in a lower rating to that party and a higher rating to the other. Continuing to do this work became impossible, so I did resign from Moody's in 2010. And I made it a full-time self-financed effort to track the regulatory response to the failed ratings, which were at the center of the financial debacle, and which permeate all the instruments we're discussing today, whether you describe them as shadow banking or insurance. I didn't simply track, however, I also contributed. I wrote comment responses to the SEC proposed rules for NRSROs, which are the rating agencies. I wrote comment responses with respect to the Treasury's Department to attempt to revive the private label RMBS market and other cases. And unfortunately, there's a really sad takeaway for the country and a great takeaway for rating agencies. Nothing has changed. There are no checks and balances within rating agencies or in the regulation or oversight of them, and there is no market check and balance of the rating process. So the rating agencies have no accountability in assigning ratings. That is great news. It's bad news for the country because ratings are a factor in investment decision. They do factor how, in part, capital is invested in some sectors and not in others. So it's not good for the country, but rating agencies are doing financially very well, and I think a big lesson they have learned is that they can brazen out anything so long as they abide by the very limited requirements of them, which is to publish their methodologies, to publish their ratings, to determine their own internal mechanics for developing methodologies and ratings and acting accordingly. Those are the only obligations that the only really material obligations that rating agencies have. The SEC, I think, is actually abetting this situation. There's a range of legislation which had effects, some of which the SEC has issued a no-action letter to prevent from taking effect, and others which the SEC seems to abide very, very carefully. The SEC is very clear that it cannot comment or oversight the content of methodologies, the content of ratings. We heard this in testimony, and it is the SEC has cited the amendment to the Securities Act, which makes this explicit. But on the other hand, Dodd-Frank did have a provision to expose rating agencies to expert liabilities similar to accounting firms and other financial gatekeepers when their ratings are used for certain types of asset-backed securities. What was reported in 2010 is that the rating agencies threatened to go on strike. And there was a concern when the economy was so fragile in 2010 that anything that could be done to keep the economy puttering along needed to be done, and that a potential shutdown of asset-backed security issuance was not needed. The SEC actually acted preemptively to avoid this threatened strike and issued a no-action letter, Ford Motor Credit no-action letter, which had the effect of nullifying the Dodd-Frank provision, which would have exposed rating agencies to expert liability in certain instances. I just want to read the excerpt from the Securities Act, which the SEC cites for its hands-off approach with respect to methodologies. And I should add that even in the European Union, ESMA, the equivalent follows a similar practice. Notwithstanding any other provision of this section or any other provision of law, neither the Commission nor any state may regulate the substance of credit ratings or the procedures and methodologies by which any nationally recognized statistical rating organization determines credit ratings. And the SEC does hew to that policy. Most of their oversight of rating agencies is with respect to the self-determined policies that each rating agency determines to develop methodologies and assign ratings. And there is also focus on individual conflict of interest, but not corporate-wide conflict of interest. The rating agencies know that, in a sense, their safe harbor is to publish, and they publish a lot. Because I've written rating methodologies and rating announcements, I've read a lot of the methodologies in key sectors, such as those for derivative contracts that are used by asset-backed securities. The methodologies show that the numbers don't add up. I've read the bank methodologies, which often have an assumption of government support in two instances. One for the bank, and then a second for many of the type of instruments that are used in the shadow banking world, like derivative contracts, like letters of credit, like certain guarantees. The assumption is that those type of obligations are so important to the operating of the system that they will somehow be saved and continue to operate even if a bank fails. And I will add that in the methodology I'm thinking of, there's no even numbers behind this assumption. The size of the derivative contracts or letter of credits, they're not tallied. It's a simple assumption that the bank is measured as if we're back in the Eisenhower era, where it's got assets and liabilities. And then all these obligations are at the top, like derivative contracts, and that those will be fine. And that an explicit rating assumption rests on that. And so long as the methodology describes this, the rating agency has done what it needs to do. There's another area, too, that it might be familiar to people in Washington, and that's with respect to student loans. There's the discontinued FELP ABS program is showing, as other student loans, very slow repayments. And deals that should have had a legal final by 2020 or 2030 are now amending legal final so that the deal will extend to 2060 or 2070 or 2080. The rating agencies raised the issue, and they were the recipients of vociferous lobbying by the industry to scale back their proposed methodology, which would have resulted in downgrades and would have resulted in deals being more expensive to bring. But this is certainly an example of maturity extension if somebody is investing in a bond that has a legal final of, say, 2080. And the AAA rating is partly based, or largely based, on the FELP guarantee, but then also an interplay of 2080 is so far away that the student might die, might become disabled, the government guarantee might kick in. And it becomes a sort of a very generous modeling assumption, whereas you might think that if you're going to model a deal to 2080, you really should be injecting conservatism into that approach. I'm going to read a rating definition by one of the rating agencies. They are allowed to define their ratings. Ratings are not facts and therefore cannot be described as being accurate or inaccurate. And that's a nice out, to be able to say that what you produce can't be described in any objective terms. Users should refer to the definition of each individual rating for guidance on the dimensions of risk covered by such rating. And I will say that is fair warning, because a rating agency can determine that its rating only addresses one part, for instance, of a bond and not the entirety of the bond. Or a rating agency can determine that its rating addresses a bond, but only when interest rates are below a certain level. Or rating agencies can define a promise that has no bearing on the bond, but is what they wish to rate to. And they do disclose that. But the actual rating looks the same. And so when an investor or a regulator or an insurance commissioner looks at the products that are being held, they won't see these distinctions unless they do the nuanced reading of what the rating definition addresses. Just because I'm in Washington, maybe to give some scale, around the world at all rating agencies who in all sectors, municipal, corporate, sovereign, asset-backed, derivative contract, there are in a total 5,000 analysts. This is half the number of staffers on Capitol Hill. And yet they are responsible for developing these ratings, which are used everywhere in the real and the financial sector. And because ratings are treated as opinions, the rating agencies have opened themselves up to lobbying, as I mentioned in the example of FELP ABS. What would I like to see rating agencies do? I would like to see them treat their ratings as a closed system that offsets credits and debits across all sectors. So that, for instance, if there is an assessment that the banks are going to receive financial support either for the bank itself or for derivative contracts, there is necessarily a lower rating on the sovereign. People don't like lower sovereign ratings, but it signals to the country that we are developing risks and that these could explode again. What could the SEC do? I think they should rescind the no action letter that has shielded rating agencies from expert liability when their ratings for asset-backed securities are used. And I think we should wait for the rating agency response, even if it is a strike. In building a system that's going to work this year and next year and 10 and 20 years, I don't think the very, at best, nebulous information that is presented in ratings is going to help. Thanks.
All right. Thanks very much to all our panelists, and we have a couple of minutes now for questions. I'm going to start out with sort of moderator privilege and asking a couple questions and then open it up to the audience. I wanted to start out by asking, actually, Adam, since you're one of the folks here who's located much closer to Wall Street than we here in Washington, D.C. are. What kinds of changes have you seen in what you would call shadow banking markets since the financial crisis? And where do you think are some of the areas of emerging risk in shadow banking that people are already doing deals on Wall Street, but maybe we haven't gotten our arms around here?
Sure. So I think I do think that we have put in place a pretty impressive set of rules around capital, liquidity, and resolution planning that we shouldn't discount. I think the challenge is that those rules can quickly become outdated in the way that the financial system responds to those rules. There are lots of efforts by the industry to get around, for example, in my current area, the liquidity coverage ratio, by engaging in transactions that are very friendly. For prime brokerage traditionally, as an example, was a cash business. That's now increasingly becoming a synthetic business, in part to get around some of the rules around leverage and liquidity. So those are some areas of concern where we're going to need to continue to adapt. I would echo Bill's concerns about ratings. I think broadly, rating agencies are just a very important part of our capital markets in order for them to work well. It's very difficult for very diffuse investors to everybody invest the diligence that's necessary into each product, just given the free rider problems that exist. And so we need well-functioning rating agencies, I think, in order to make the capital markets work well. And I think we still have some opportunities to improve there. So.
Okay. I guess maybe as a follow-up question, both to Adam and Bill, one thing that's been raised by regulators post-crisis, and we saw this in the leveraged loan market and so on, is the concerns about the flow of corporate credit into the shadow banking system, or how the shadow bank system is intermediating corporate credit in new ways, both through the CLO market and through corporate debt funds, the increasing holding by investment funds of corporate debt. So what have you observed about that, and do you think there are potential issues there?
I think there are issues associated with the normal credit cycle for leverage loans being amplified by the involvement of mutual funds in a way that they haven't been involved in previous cycles. I do think that's already on the downside given some of the events of later last year. I do think that mutual funds, while some of them can have redemption rights, most investors don't view them as close substitutes for money, and so I don't view them as them themselves as creating the systemic runs that really scare the heck out of everyone. But that doesn't mean that there couldn't be significant losses and people that took more risk than they thought. So.
I don't come from the systemic vantage that Adam has, but we have seen in the CLO market, which was sort of promoted as one of the pristine asset-backed security markets, that it came through the crisis better than others, and that where issuance has resumed, that some of that issuance in the last 2 years has been supported by what I described, which is a tailored rating for a repackaging at the time of issuance. And it's very complicated. I don't know that I could go into the weeds here, but it goes to the issue that the rating agency assigns a very tailored rating. And it only addresses ultimate return of principal, even though the bonds pay many other things. It seems these might be bought by insurance companies, which do use ratings to then map to the NAIC scheme. And so the question is, if it is insurance companies or other entities, are the regulators aware that, yes, it might have a Baa3 rating, but it's not a Baa3 rating for current interest in principal, but only that when you put 4 tranches together and issue a new security, and it's going to be paying all sorts of things, and you're going to cough up the money eventually. And it's not clear to me that it is clear to me that supported issuance in even the CLO sector. It's not clear to me that the regulators would understand what that rating really addresses.
So one last question before opening it up to the audience, to Carolyn Soko. You discussed the role of banks as dealers in the repo market. I'd like to talk for a minute about banks as dealers in the derivatives market. Banks are the major dealers in the derivatives market. They hold something like 95% of all the notional value of derivatives is held by just fewer than half a dozen major commercial banks. And derivatives are not themselves corporate securities, but of course they reference the value of all kinds of different securities and market valuations. And we saw this debate in Washington, D.C. about swaps pushout, about whether there should be a separation created between commercial banking and derivatives dealing. Can you just talk a little about what that relationship between commercial banking and derivatives dealing says about the financial system? And you mentioned also Glass-Steagall and some of the lessons of the 1930s, how that relates to those lessons.
Yeah, I mean, I think when you look at the derivatives markets, there's such close ties in terms of the way collateral is used between the repurchase agreement market and the derivatives market, that essentially you have a very similar issue going on, where the banks end up, the commercial banks, by being very central to this whole issue of using collateral, of short-term lending that is secured by corporate sector collateral. And granted, that's much smaller now, but the system is still structured so that as people find they don't have enough collateral, that corporate collateral is very likely to increase as people as the different people who are posting collateral end up running out of treasuries and other things they can post. We can expect corporate securities to be used more and more. As a crisis starts to approach, we'll see a growth in the use of corporate securities as collateral because that's what they have. And when the banks are essentially part of the system of funding collateral on a short-term basis, it's very difficult to avoid this interaction between the growth of commercial bank liabilities, which are so closely tied to the money supply, and the growth of asset prices. And it's creating this interaction. It does so very clearly in the repo market, but the derivatives collateral is very much tied into the repo market as collateral moves back and forth between repo and derivatives collateral when the banks are financing themselves. And because of this, there's an inherent problem, basically, with having the commercial banks involved in the short-term finance of long-term assets, such as corporate securities. And until we put some kind of a firewall between the commercial banks and what used to be called investment bank use of repo, essentially, it's very unclear that it will be possible to avoid asset price bubbles that then fall apart in the classic Adrian and Shin story that we've been talking about for the past, almost 8 years now. And essentially, the derivatives collateral is equally a part of the problem as the repo market. And we need the commercial banks, in my view, to essentially be firewalled separately from the investment bank use of repo.
Okay, let's open up to the audience. And could you just state your name and affiliation to start as well?
Michael Bradfield, the Volcker Alliance. I guess one of the issues that was raised in Governor Tarullo's speech here today and underlying a discussion here is what is the importance of near money that's created as part of the shadow banking activities, and is that essential for the economy? Is it, if you remove the exemption from the stay, automatic stay in bankruptcy, if you did some of the things that Ms. Carolyn Sissoko, has recommended, is that going to have a devastating effect on the economy? What role is this near money playing, and is it important?
So if we reduce the moneyness of things, is this going to have a negative effect on the macroeconomy? Yeah.
I mean, you mentioned the stay. You're referring to the 2005 change to the bankruptcy code that extended the special treatment for repo and derivative type collateral from just government collateral to this whole range of other securities. And I think that would be great. I think there were attempts during the Dodd-Frank legislation to do that. Now you would, of course, have to fix that in Title II as well. I mean, we survived until 2005, and I think it makes sense to make that change, but it would require Congress to act.
And I think, it's true that there is this huge demand for safe assets and for these near money items, but in some sense, we created that situation because as soon as you set up a system where you can lend on repo, there's no reason to use commercial bank deposits because you've got a better asset. So why do we have this huge demand for safe assets? It's because we allowed something better to develop, right? And you really need to start thinking about how do we roll back some of the problems that were created by this new system that actually is fairly recent. I mean, it's only a decade or two, decade and a half, that we've created the system where we've given corporate treasuries and asset fund managers a means of investing in something better than an unsecured deposit or an unsecured liability, and it's not clear that we can make the system work. So you kind of say, well, is it going to make things worse? Well, right now we have a lot of instability, and as Governor Tarullo has said in many speeches, the fire sale risk of the repurchase agreement market has not been addressed, and we don't really know how to do it, and it's not clear that we ever can address it. How long have we been looking for solutions? And I would basically say that we need to find a way to go back the other direction. Because where is stability supposed to come from if you have built-in asset price bubbles that are going to crash? And that's a fundamental segment at the heart of your financial system. I mean, why would you expect it to be stable? And I could look historically, actually, I've got a paper on 19th century British banking, and they thought this was a problem back then too, and they addressed it. So.
Okay, other questions?
Adam suggested that there's no problem with respect to the UK with the real estate funds had a run on the real estate funds, and they just closed down the door. They pulled down the shades. And is there a systemic problem from the mutual funds investments in commercial loans to companies? Is there a risk that then this market has grown very substantially? Is there a risk in that market that will have systemic effects?
I think the concern I have around leverage loans is that by their nature, they don't amortize. They rely heavily on refinancing. And so refinancing liquidity needs to be out there constantly in order for this market to function. They also are floating rate. And so they benefit from the fact that when there generally are problems, interest rates come down. And so that can help firms work through problems. I think we're in a situation now where there's not really a scope for further reductions in interest rates, and they're very dependent on the continued supply of refinancing liquidity. And if there's a disruption in that, that could create a problem. Now, would it be a systemic problem? I probably wouldn't think so. I think even in the case of the UK funds that have been having some challenges, that hasn't led to contagion more broadly within money markets. There are relatively sophisticated people that might not have done as much diligence as they should have, but ultimately we do have private capital markets where people have to eat their losses when they make mistakes, and I don't think that itself will lead to systemic issues. I do think that obviously the broader issues around the value of the property market, those could have impacts on the economy, but just that issue around the mutual funds, I'm not as concerned about as some of the other things that we've talked about today.
I'd like to kind of ask a follow-up question on something that's sort of tangentially related to this, but very important in the Washington, D.C. discussion, which is what is systemic risk? I think a lot of people starting with Adam, you kind of laid this out, that systemic risk is about a catastrophic run like we saw in 2008. But to what degree is systemic risk about poor capital allocation, about just the markets that don't allocate capital properly, and that to what degree is it about credit cycles that are more extreme than they need to be? How broadly should we look at the question of systemic risk?
I think that they're both important. I think just the shadow banking aspect focuses on the catastrophic stops in the financial system that require massive interventions. It's clear that the things that we're talking about, the problems in financial markets, amplify the financial cycle. They do cause misallocations of capital that make things worse off in the long run that are important. But I would kind of put those on a different order of magnitude as the catastrophic stops in the banking system.
This goes to an issue I raised early on, which is okay. Shadow banking is one way of conceptualizing systemic risk, but my own sense is that I wouldn't want to go so far as to say, well, misallocation of capital is systemic risk. But I think we can define systemic risk relatively clearly as scenarios in which problems in the financial sector then have a knock-on effect, a disproportionate knock-on effect on the macroeconomy. Okay? And I think from that perspective, I do think it's clear that some of the elements of shadow banking are probably at the heart of the problem. But I also think that it's true that there are a lot of different ways in which those types of problems can become amplified or can become larger in a systemic sense than just the shadow banking system. So if you look at 2008, I don't think it was all about just shadow banking. I think you then had a lot of sort of broader contributors to the problem. Now maybe they were triggered by some of the shadow banking. There was the run, and then that led to freeze-ups in different credit markets, but I think that to go back to the question about mutual funds, right now it's not causing destabilization. But if they occurred in a different context, if we had some mutual funds refusing to pay out and Brexit had triggered some broader run, then it could have been a very different story. So I think it's correct to start with the things that create runs. And shadow banking, I think that's where you want to start. But I also think that if you say that's all we're going to focus on when we're looking at systemic risk, you define the problem too narrowly. Because the fact of the matter is that we're never going to get it perfectly right in that scenario. We're never going to perfectly prevent runs. And so you need to then think about, okay, what interactions are there going to be where we have, say, variable annuities, top of that. Okay, variable annuities, they're runnable in some sense. They're quite very runnable if they're deferred annuities, depending on the surrender charges. But one of the reasons they create systemic risk is actually not about the runnability at all. It's about the fact that they essentially are market guarantees made to a tremendous number of policyholders. And if those market guarantees over a period of maybe even months, maybe even a year or two, start not paying out, there's going to be broader panic. And there's going to be broader effects on the macro economy as a result. So I would like to, while I agree with the starting point, I guess I don't agree that that is the only parameter that we should look at when we're thinking about systemic
And just to
risk.
follow up on that, when you look at the experience of the 2008 crisis, there was a massive overvaluation of housing that was driven by the asset bubble, and that directly supported consumer lending through home equity loans. We had hundreds of billions of dollars a year in home equity loans that were being handed out. People were using their house values as a piggy bank. Even if the financial system had held up, the rapid drop in housing value there would have had a devastating negative effect on consumer spending that would have had some macroeconomic impact. So,
to extend it even further, I mean, with a lot of these entities, they're funding a lot of these corporations with corporate bonds. Okay, so if we have a dry up in these markets as a result of a run, we could see some substantial, credit availability problems that then have broader macroeconomic consequences. So, I think that it's a difficult issue.
I don't disagree with you. I just think if you had a blank piece of paper and could do everything, yeah, sure, we're all for all that.
Right.
But to the extent you could only do 2 or 3 things, you might want to focus more on the catastrophic failures than and work with the second ones after that.
yes, in the back. Yeah.
Thanks. Jill Satina, Office of Financial Research. Several of the panelists made some good reminders of ways in which the banking system was interconnected and played a role, in interacting with shadow banks. But I thought that there was one piece that kind of really perhaps didn't quite come out of the conversation, and that actually I believe still is a topic of debate in terms of policymaking, and that is, during the crisis, the way in which some banks did provide support to affiliated money market funds, and arguably even more broadly to other affiliated asset management vehicles. And as I understand it, there is provisions in the Volcker Rule that prohibit and make it illegal for banks to now support their money market mutual funds that are affiliated. But it's perhaps a little less clear whether that provision extends more broadly to other types of asset management activities. So first, I'd be interested in whether the panelists have any perspective on that question. And then second, my understanding is there is a discussion internationally about whether there needs to be something to address this possible bank step-in risk. And I'd be curious about panelists' perspective on that. Thanks.
I'm sorry, I didn't quite hear the second question.
So the two questions were whether people perceive that we have something either in the Volcker Rule or other parts of the financial reform agenda that address step-in risk on bank-affiliated asset management that's not money market funds. And then the second piece is, do the panelists think that there's a need for that? This is a topic that's being discussed actively on an international basis, as I understand it.
Anybody want to? Okay, so the Volcker Rule fund prohibitions center around some specific exemptions in the Securities and Exchange Act, some specific exemptions from registration. So I think the key question becomes: do you use those exemptions? Has the bank used those exemptions legally in setting up the funds? And I think banks are already looking for ways to set up fund structures that don't use the exemptions targeted by the Volcker Rule. And there are also some exemptions, statutory exemptions right in the Volcker Rule, like business development companies that are potentially significant. I think in general, the Volcker Rule actually is a topic we don't have unlimited time, but we haven't talked about enough because it's something that does try to restore some of the principles of Glass-Steagall, but I think there are just a lot of issues right now in terms of transparency of the Volcker Rule, how the Volcker Rule is being implemented, whether it's being effectively implemented, that there needs to be a lot more public attention to. But that's going to have to be a topic for another event, and because we're going to have to close up. But Jennifer, you get the last word.
Oh, well, I was going to return to Jill's comment. I don't know if you're talking about Section 619, which is the Volcker Rule focused on the private fund limitations and prop trading, or if you're talking about 621 and the asset-backed securities conflicts of interest. We can just talk about it later.
Okay, well, thanks, everybody. And thanks very much to our panelists and participants.